Hi, and welcome to this session on redesigning the financial system to fight climate change. I'm Rachana Shanbhogue, finance editor of The Economist, and to discuss the question, I'm joined by Jim O'Neill, chairman of Chatham House, Adam Matthews, director of ethics and engagement at the Church of England Pensions Board, Colin Hunt, chief executive of Allied Irish Banks, Saadia Madsbjerg, co-author of Making Money Moral and former managing director of Rockefeller Foundation. So I'd like to start off with a broad question for all of you, just to kick off the discussion. Can we fight climate change within the parameters of the current financial system? Jim, what do you think?
I don't think we can. I think the fight against climate change is part of a broader issue of trying to have a greater purpose than just profits. There are some other items that we probably won't get into discussing that warrant the same kind of different approach, but the financial system has to learn or be taught or changed in order that what's often referred to by economists as externalities aren't externalities, and they're part of the system that all of us must solve.
Adam, what about you?
I agree that the challenge is enormous and time is hugely against us. I do, though, think that there is a possibility if those at the top of the investment chain, those that are pension funds, serving beneficiaries that have similar interests, be they in Japan, South Africa, America or Europe, that there is a chance to drive change and to instill those values in the financial system, as Jim referred to.
And Colin, what about you? How do you see it from the top of a bank?
Oh, well, I think this is the challenge of our generation, and we'll be judged in history as to how we've responded to this more than anything else. I do think that the tools and the parameters are there to actually see the banking industry play a far, far more meaningful role in terms of tackling climate change head on. This is an industry that understands financial incentives and financial sanctions like no other. And I think that there is certainly a role for regulators, for investors, for broader society to demand more of the industry.
And Saadia, what does your research suggest?
Fighting a problem starts with a recognition that there is a problem. And I think that's a great starting point, because writ large across the financial system, there is an understanding that climate change is a systematic risk that needs to be taken into consideration. So that's, having that as a starting point is great. Now, can it be done? My take on it is yes, it can be done, but it requires new tools, it requires new ways of working, and it requires partnerships across the boundaries, reaching beyond the financial systems if we are to get it right.
That brings us quite neatly to the sorts of changes that need to be made. And Jim, if I can come back to you, you talked about the importance of pricing in these externalities. So what does that mean in terms of changes that need to be made, and who needs to be making those changes to ensure that the externalities are priced in or internalized?
I guess, as with many things in this peculiar world we're living in during this discussion, my honest answer is I don't know. I don't know the answer to all these things, but I have increasing suspicions that our financial policymakers need to adjust their mechanisms in order to have the capitalist system focusing on a better balance between maximizing profit and reducing the scale and size of inequalities, of which climate change is a major one. And specifically in that regard, and involved with some work I'm doing with others, it'll become public later this year that it's an idea we want to pursue, is the whole idea of making the Financial Stability Board, which originated out of the catastrophe/crisis of 2008, essentially has new responsibilities to try and guide capital adequacy of our financial system, to make sure there is incentives to improve the health of all of us around the world, including what's necessary to beat climate change.
Colin, can I ask what you think of that as an approach, sort of embedding, incentivizing banks and financial institutions to act against the sort of the threat of climate change, and also what regulatory changes so far have you found actually quite helpful in this regard?
I think it is fair to say that we're probably at an early stage in terms of regulatory developments in this particular area, but it's very clear there is a direction now towards this being a increasingly important item on the agenda of regulators. We're seeing that in all of the financial regulators around the world. And the regulator has a clear role to play here, in that there should be, in my view, an advance notice of increasing risk weights being applied to assets that are damaging to the environment. And I'd also be of the view that there should be an incentivization of banks to promote more responsible lending, more greener lending, more carbon neutral lending, by adjusting the risk weights for assets that qualify for a responsible label. But there is clearly, this is now a major theme, and this is only going one way. You can see it coming through stakeholder engagement as well, even from shareholders. And a number of years ago, shareholders would have been very, very much focused on what's the next quarter results, what is your bottom line, whereas now there is a far greater prominence given to the broad ESG agenda. And there was a view, I think, if you go back to the start of the pandemic, that the health crisis, the pandemic crisis, was so immediate that we were going to see a sidelining of the issues of sustainability and sidelining of the broader ESG agenda. I think the opposite has happened, and that over the course of the past 11, 12 months, we have seen the importance of sustainability being highlighted, particularly in the investor community, because like nothing else, the pandemic has exposed the fragility and the frailty of the system that we used to operate in.
And Adam, can I bring you in on this? Do asset owners in general sort of understand the externalities involved here? Could they be encouraged to think through this lens more?
I mean, absolutely, they understand it, and they are starting to put in place the kind of interventions that need to be driving the change that needs to happen at the pace that's sort of equated to the Paris Climate Agreement. But we're still at the beginning of it, and so that's where the concern comes, whether we can mobilise this movement at a sufficient pace to drive the change aligned with the sort of key points in the path to Paris. I think we, through initiatives like Climate Action 100, where you've got 52 trillion mobilised for 543 investors, as never before, you've got a clear expression of we need to see plans from companies that are aligned to the goals of the Paris Agreement. And we're now moving from let's just see your targets to what's your plan, what's your strategy, what technologies do you need? Demonstrate to me that your plan's feasible, demonstrate to me that that technology is going to have the role that you're saying it's going to have. And then in that case, we may then be able to provide the finance or the transition finance that you need. But it is going to be based on a very robust conversation. And I think this 9-year, this decade of transition we're in now will determine whether we meet the Paris goals or not. And I think a lot of the key decisions are going to be taken here. I agree with Jim's point that basically there's some more fundamental realignment of the financial system needs to be done at a sort of macro level, at the governance side of it, but also asset owners are actually collaborating in a way that there's never happened before, and we now really need to sort of push that through. We do though need common good public tools that enable us to really play this role and hold the different parts of the financial system that we interact with accountable to help us achieve these objectives.
What are those common good public tools?
Well, if you look, I mean, we're involved in a range of dialogues through different sectors. I mean, I lead on engagement with Royal Dutch Shell. I know for Shell to transition, it requires a complete shift through its value chain, be that into the road haulage sector, aviation, shipping, etc., all the different aspects of its customer base. And we need to be able to not only capture the commitments from the company, which we're starting to do through tools like the Transition Pathway Initiative at the London School of Economics, but also then work through their value chain, their customer base, to understand the commitments that they are putting in place, because we're owners through that value chain. And you can start to actually hold that whole chain accountable. And based on credible plans, that same understanding can also then provide confidence to investors to release the transition finance that's going to be critical to a lot of these companies achieving their objectives. But to do that, you also need the enabling policy and regulatory environment. And at the moment, that's where you've sort of got part of the sort of puzzle that really sort of needs to move forward at a greater pace.
Saadia, can I ask, are there approaches that we've tried and have failed and that should be discarded? Or are we just so early in our approach to using finance to sort of ward off the threat of climate change that it's just too soon to say?
I think what's happening at large is there's a lot of new thinking and innovation. And that's exactly what you need. You need innovation and new tools that can help you manage the risk in your investment portfolios, but also importantly, invest in new solutions, because it's not enough to just say, let's look at where our investments are and let's mitigate those risks. You also have to say, what are those new companies? What are those new business models? What are those new ways of building infrastructure and cities around the world that's actually going to make a positive contribution? And I think we see solutions both on the financial side, but also in terms of the actual products coming into the marketplace. Some of them are going to work and some of them are not going to work. I think there's been an interesting development if you just look at the VC money that has gone into green tech. You know, a decade ago, a lot of investors lost money on it because the market wasn't ready and those products couldn't quite deliver what was expected of them. Today, it looks completely different. I think the other thing I'd like to add to it is also, you know, as Adam was talking about a robust conversation and understanding, I think it also requires that we, as a broader community, investors, corporates, but also the policymakers, expand the focus when we talk about climate change. It isn't just about reducing greenhouse gas emissions, right? It's also looking at biodiversity. It's looking at the value that nature as it exists today, whether those are forests or mangroves or reefs around the world, provide to society, and how to protect that value and how to build on that value. And how to do it within our investment portfolios instead of that being something that we rely on governments and philanthropy to take care of.
Adam, I think you wanted to come in on this.
Yeah, no, I mean, I couldn't agree more, which I'm sure is painful for a host of a discussion panel. But the issue of biodiversity, I mean, if we haven't got climate sorted, we definitely haven't got biodiversity sorted. And that is an enormous challenge that we are simply way behind the curve in terms of investor engagement and understanding. I mean, we're at the foothills of starting to put in place the kind of steps we're starting to see if actual returns on in terms of climate. But on biodiversity, we've got a great deal of catch up to do there. And my fear is that is going to be a complete sort of, we're just not at the party at the moment if we're going to really address this challenge properly.
Saadia.
So that also allows me to go back to the point that we had in the beginning, which is there's all the knowledge and expertise that resides within the financial system today that we need to put to use. But then there's also the knowledge and expertise that currently lies in the big NGOs of the world that have been working with biodiversity for a really long time. And I think a lot of the interesting impactful solutions are going to come from when you bring together the world of the asset managers along with these NGOs to develop viable investment models that can allow you to do both.
I'm guessing nobody else on the panel wants to disagree with biodiversity being an important subject. Jim, go ahead.
In some ways, I think it's, as I hinted at earlier, I think it's kind of broader, really, that as you may know or may not know, I've been heavily immersed in the topic of so-called antimicrobial resistance for the past 6 or 7 years, which is at the core of it is the growing resistance to antibiotics. And it became well known because of how many people we suggested could end up dying every year if we lose all effective antibiotics. And some people around the world sort of believed these were kind of pretty outrageous typical economics forecasts. But this crisis has demonstrated through this unique pandemic that those kind of things can happen. And I say all of that because, in my opinion, the right way to deal with all these issues, of which climate change is right in the middle, is in some broader thing. I think, and here I might disagree with other members of the panel, hence why I'm interjecting. I'm not sure the system can just do it for climate change. We need a system that that needs to be able to focus on optimizing a number of goals and business sort of relearning something that probably hasn't been there for most of my adult professional life, that whilst everybody's trained to think in terms of maximizing profit, it's of no purpose if the societal remit isn't there to deliver broader things. And for all of us in this generation, having business deliberately shut down and not being able to function is a consequence of what happens if you allow these externalities to just go on and on and on. And I'm not sure, like I said before, that I don't have all the answers, but we need to do something to have a more sophisticated system in which everything operates, including the fight on climate change.
That's a really good and sort of broad and deep point, and I'm not going to do it justice with the question now, Jim, but is one of the things that needs to happen that we move away from thinking about GDP as a measure of economic, social success? Is that would that be a sort of the first step, perhaps, towards thinking about the broader societal remit of business and the economy?
I think it's something to be explored, and I have spent a lot of time on that the last few years, in parallel to what I just said, but also slightly separately. The dilemma with this particular path is, as bad as GDP is at capturing many things, it's pretty hard to think of something that's better. And I think you can address it differently whilst trying to find a better way of having a better value of broader economic and social value than GDP, and that is to try to not force, it's too strong a word, to encourage business to get away from just the single pursuit of profit maximization. And I say that as somebody that's thrived in the world of business for the best part of 40 years. So some would think it an irony, but the way the system has evolved is that there's a complete obsession, particularly with publicly quoted companies, to make profit in the next quarter above what analysts are expecting, almost whatever any consequence. And it's kind of crazy, but that's a symptom of the scale of where we've evolved to in capitalism has got. And you can change it by changing the set of incentives, and for example, not allowing companies to report or produce some of the rewards of those profits, such as through share buybacks and other things, unless they're contributing to certain goals, such as, I don't know, you could be as broad as contributing to productivity of that particular country in which firms operate, as part of it, some stated national goal for reducing net zero, which could be overseen on a global level by some very strong framework by the G20, etc., etc. Hence why I said early on about a much bigger and stronger remit for the Financial Stability Board, which sits under the remit or the leadership of the Group of 20.
Now, that would have huge implications for how businesses are run and how investors and shareholders and businesses interact. So maybe I can ask Colin here, as somebody who runs a business, what you make of the kind of pressures that businesses face to sort of address things like climate change. And I'm sure there are sort of internal ones coming from employees, but also from investors, and whether that can, how that could drive change.
Well, I think there's already a shift underway, to be honest with you, in relation to a move away from a sole focus on the financial parameters that Jim was talking about there, the obsession with the next quarter's results. And over the course, really, the past 3 or 4 years, I have noticed a marked upgrading of the importance given to the general ESG agenda by investors. If you go back 4 or 5 years, the bulk of the presentations, the bulk of the investor engagement was on the financial parameters. It was on your cost base, your income growth, plans for the future in terms of how you're going to develop both those lines in the right way from a financial perspective. But now, and ESG was almost an add-on at the end of a meeting, whereas now it's very much moving front and center. And I do think it's important also that we recognize the fact that this is more, sustainability is about more than just climate change. It is about a far, far broader set of issues. It's about the environment. Yes, critically important. It's also about diversity, and it's also about equality. But the really, really interesting shift that we've seen in the past number of years has been that the sort of debate about whether climate change was real, that's now gone. It's real. The science, the facts, the data all prove it's real. There is almost a universal acceptance now in the business community that it is real. And there's a realization that we have a special responsibility, and particularly the banking industry has a special responsibility, not only as significant businesses in their own rights, but also as providers of capital to economies to help accommodate a more rapid transition to a safer, less carbon intensive future.
Adam?
I suppose the question back on that is your bank stopping its lending to companies that are not aligned to net zero? And I think sort of investors holding the banks that they're shareholders of on that kind of issue is absolutely critical. But I also just want to push back a bit on Jim, because I do actually think that there are changes that are happening within the market that are being driven by investors that aren't doing it purely on financial grounds. They're doing it because they recognise companies operate in society, that they're part of society, they're not in a vacuum. And I think if you look at the recent example of Rio Tinto in Australia, where you have a hugely profitable company, extremely successful at the moment in terms of the returns to shareholders, providing many of the minerals needed for the low carbon transition, but yet the board's removed the CEO because shareholders were not willing to accept the kind of way the company was behaving in relation to a particular incident in Australia and a heritage site that was particularly important. And there, I think investors exercised a clear expectation the board needs to take action. Now, that's one small item. I mean, one of the other areas we're working in is the mining sector, across the whole sector, on the waste course from mining. And there you're starting to see fundamental change across that whole sector, which we desperately need to succeed for the low carbon transition. That's going to have huge demands on it to produce more waste, because it's going to have to mine more products that are needed for the low carbon transition, which in and of itself is going to put greater risk on the environment and also on human lives. And through investors, we have begun to see a significant change in the way that the sector is responding to the issue of mining waste following the Brumadinho disaster. Unfortunately, it's taken disasters or incidents to really sort of catalyse investor action. But it is happening, and it is driving standards in a way that haven't been driven before, because I think asset owners are starting to drive expectations that they will not invest in companies that do not acknowledge their responsibility to society, their position in that relationship, and have credible plans to do it. We will work with them to help them ensure that they're dealing with that properly, but there does come a point that we will also draw a line. And I think you're seeing a much more robust expectation coming from investors. The possibility is to now really do that in climate. And again, you're starting to see that change on climate. It's not yet at the pace it needs to be, but it is possible. Fundamentally, we're working for beneficiaries who are people that are wanting to have a pension fund and a world to retire into. And you can hold those two things and be an investor in this system.
Jim, I think you want to
just come back to, first of all, just come back in relation to ourselves. We've made a net zero commitment for 2030 in relation to our own operations. We've made a 70% commitment to net zero lending by 2030 with further ambition beyond that. We have a growing list of exclusions, areas that we just will not lend any money into, and that's expanding with every passing month at this juncture. And one of the things that I was also very, very strongly interested in was we've set out our stall. We work with a huge number of third-party suppliers, and we're now saying to them, if you want future business with us, you need to adopt the same principles that we have.
Go ahead, Jim.
I hope what I just hear there is indeed going to spread everywhere, but it's not easy. And I know one of the things that concerns policymakers with the financial system is, the fear that there comes a point where if they were to, especially if they were responsible But even if they just presided over the kind of spirit that we've just heard from the two investors here, that, you know, that this in itself could cause the financial markets to go into some kind of meltdown, and particularly if areas with leverage. You know, I heard a very interesting, provocative case about all of this recently with South Africa's nationalised energy supplier, which is riddled with debt. You know, what should happen to that? From a climate change perspective, it probably shouldn't be supportive. You know, what would we say about the same for many Middle Eastern oil-producing countries? Would we be prepared to risk massive destabilization of their countries because the oil revenues provide such powerful flows, et cetera, et cetera? So it's tricky. But I'm now going to contradict myself. One of the wonderful things that I observe during this pandemic is the financial markets, through equity prices at least, do indeed seem to be generally, this is a broad simplification, rewarding the pioneers in the fight against climate change, whether that be Tesla in autos or many new energy companies. But it's tricky because there are some players and some nations and some systems that have got a lot more to lose than others.
Saadia?
So building on, what I heard everybody else talk about, it isn't easy. I mean, it clearly isn't easy. And that's also why we don't talk about just doing a fundamental, drop one industry and go over to another. There's talk about a transition. And there's the question of what does it take to do a transition and do it responsibly with integrity, where, the financial system stays intact, but, we also address the big problems that we have around climate or biodiversity or others. I think there are interesting case examples that we can look towards of investors that have gone in and helped with that transition in the very early days. Like these days, you wouldn't find a single pension fund or insurance company that isn't looking to invest in renewables. 10 years ago, the market looked very, very different because there was a lot of uncertainty in terms of what that's going to look like. And there's a pension fund in Denmark, Pension Denmark, that, post the 2008 financial crisis, was, from a financial point of view, looking for investment opportunities that would give them more stable returns than what the equity markets could do, but higher returns than what they could get in the fixed income area. And they decided to go into the renewable infrastructure space. This was very, very early days. They were the first investors in Copenhagen Infrastructure Fund, which is now one of the biggest green infrastructure development funds, 10 years later. So a lot of it also has to do with having a bigger view, looking for the opportunities, and then figuring out how you help make that transition along the way. I mean, I completely agree with what Jim was saying about, aligning purpose and profit. I think to a large degree, we may not talk about it in those terms, but a lot of that has happened. If you look at the market for sustainable and impact investments writ large, like here in the US, $1 out of $3 under professionals' asset under management are invested with some sustainable strategy in mind. Now, is it enough? No, it's not, but we have really come a long way. And it has come from an increased understanding of what the risks are and an eagerness to look for the opportunities of where money can be put. So I see, I'm much more optimistic in terms of where we are going and what we can achieve. Both on the impact side, but also on the return side than I guess some of my other panelists.
Colin, did you want to come in there?
Yeah, I think that the point that Jim makes in relation to assets that have a heavy reliance on carbon is valid. And certainly we are going to see stranded assets. There's no question about it. If we have a successful transition to a lower carbon economy and a lower carbon society, there are many assets that are valuable today that will not be valuable in the future. And that's a growing concern for regulators as they look at the financial stability of various economies. But one of the striking things, really over the course of the past 12 months, really has been, the point has been proven that it is possible to do well in terms of lend money into assets that are good for the environment and good for society, and also not and those assets performed extraordinarily well during the crisis. So as I look at our own book, the fastest growing part of our lending book in the past 12 months and in the previous 12 months and in the previous 12 months was our green lending book, our energy climate action book. And it is unique within our own business in that it required not a single COVID-19 modification. So it was resilient through this extraordinary period of economic and societal crisis. So it is possible to do well for your business and do well by the world.
That's really interesting, and we've spent a fair bit of time talking about the sort of the broad framework and the trade-offs involved. I just want to spend a bit of time now thinking about the tools and whether sort of investors have the right tools for sort of making informed, sustainable investment decisions, whether disclosure, how far disclosure gets you in terms of investor decisions. And I might start with the two investors on the panel. Saadia, what do you think of you talked of a new toolkit in your introduction. What do you think is needed now?
So I'll talk to it from a broader point of view instead of an investor point of view. I think there has to be transparency in the marketplace, right? And what is going on currently in Europe with the regulation, driving towards a common taxonomy, driving towards regulation that provides the disclosure. So we know what we're talking about when somebody says green. Everybody knows that it's the exact same thing. There's a way of understanding who's having impact and who's not. I think those things are hugely beneficial. I think the one thing that where there's much more work needed is, and there was a study that came out last month, which warned about using models that were developed for generally understanding climate change, so in society, and applying them in a financial scenario where they said, these are models that were developed to understand what would happen 10 years out for entire regions. These weren't models that were developed to understand what would happen with asset prices in a certain part of Northern Europe. Doing that translation, getting it right with the data and with the increased understanding, I think is going to be critical in terms of tools to drive this transition forward. And I think, there's a lot of money going into it. There's a lot of eagerness to get it right. I'll go back to what I said before. You'd be hard pressed to find any asset owner or asset manager these days that doesn't talk about the importance of climate action and doesn't talk about how important it is for their own businesses going forward.
Adam, what about you? Do you see sort of barriers to making informed investment decisions when it comes to sustainable investment?
Yeah, I mean, there's always going to be barriers, but do you have enough information to make decisions now? Absolutely. We've invested 700 million at the end of last year in a passive index that's embedded forward-looking data based on assessing the most carbon-intensive companies across 15 sectors. That's massively shifted our portfolio. We haven't disinvested sectors that are high carbon. We've differentiated between which companies are starting to put in place credible plans to transition, having credible targets, and demonstrating they've got some management capability to actually start to deliver that strategy. So it is perfectly possible to do that. The challenges in some of the other asset classes, I think there's further work to be done to sort of bottom out methodologies and the EU taxonomy, which is a horrible word, but it's nonetheless it's helpful. So there is a consistent movement and information flow coming here. There isn't going to ever be a perfect place, and actually we're now at the cusp of understanding this transition's complexities in a lot of the engagement we're doing, and that's going to require us to have a whole heap of new information, but you can have enough information as it stands to be able to take meaningful decisions to start to realign yourself towards the goals of achieving the Paris Agreement and your own net zero goals, and playing a proactive role within driving change without walking away. And I think that's where we've tried to position our fund. That's where a lot of the work we do with other investors is. And I think the more we can partner with the banking community, and it's great to hear what Colin said around the commitments his bank's made, but we need to ensure that lending is going into companies that are demonstrating they've got credible plans and they've got credible ways in which to transition. That needs to be in line with us as equity holders as well. And we've got to ensure that debt is only renewed on the basis that company has a proper plan. And I think if we can sort of join up the system a lot more effectively and actually then become a much more effective way of driving that change.
Is the lack of standardization of reporting when it comes to reporting standards a problem? I mean, Mark Carney got into a bit of trouble over his use of sort of net zero when it came to Brookfield's portfolio. Is that something you encounter often, the sort of just a variety in reporting?
Well, I think when yes, I think, of course, you're going to have challenges in sort of interpreting how different things actually relate to the way that you invest and whether this is genuine impact and how you can actually use offsets. And obviously, the more that you can standardize, the better. And obviously, you have initiatives to undertake standardization underway, and I'm sure that those will continue to evolve. There is a sort of plethora of data requests out there. There's huge amount of pressures on us as a pension fund to be disclosing rafts of information. And you do want to see consolidation in that. I sort of feel that we need to get to a point where you've got common good public tools that don't require a sort of a fee or something, that can actually ensure that there's wide access from the whole market to understand the transition through a common lens. And on that basis, you can enable a much greater transition, joining up between bond investors, equity investors. And I think that will sort of help the standardization and also ensure that companies know who they're dealing with and what the expectations are and that they're standardized too. And all of this relates back to us also. How do we as a pension fund demonstrate we're in line with a net zero pathway to our beneficiaries who we have to provide a pension fund to?
Now, we're nearly out of time, and to sort of wrap up, I'd like you all to do my job for me and tell me what one thing, in your opinion, is needed to really move the needle here, just as a way, really, of summing up the discussion that we've had. So, Jim, can I start with you?
Same as where I started. Change capital adequacy rules. The idea is tough. It always was, but the world's major finance ministers and central banks did that in 2008. In fact, it's actually held up pretty well. But now they need to go at least one, maybe a few steps further, and bring directly into the day-to-day, hour-to-hour interests of everybody in the economic system to solve these kind of challenges as part of their regular life.
Saadia?
So I'll talk about it maybe perhaps at a more micro level and say, yes, the broader regulatory policy environment frameworks are important, but you also need to make sure that the financial institutions that are doing the work are aligned to creating long-term value for society. So it's about what are the things you need from an organizational point of view to root out short-termism. And that has to do with realigning the incentive models that we have for those institutions and the people that work there, not just at the executive level, but all the way down, so that they're incentivized to make investments in ways that create long-term value instead of short-term. And it also has to do with looking at the board composition and making sure that the boards of these organizations that are responsible for the performance and the long-term strategy have the right capabilities to really be driving us towards a future where it's not just about financial returns, but also about impact.
Colin?
Very quickly, I would love to see a common measurement system, the adoption of universal taxonomy here, and transparent reporting. And I think that once you get into a scenario where you have that common measurement system and the transparent reporting, you will see very significant investor and broader stakeholder pressure for companies to do one hell of an awful lot more in this space.
And finally, Adam.
Banning questions that require a single answer. It's a hugely complicated transition over multiple decades. It's never been done before. It is possible, it is achievable, but it's going to require partnerships like we've never had before outside of traditional structures. And I think that there is a possibility you can have a panel like this in 10 years and realise that, yes, we're starting to be on the path. But it's going to take lots and lots of different interventions, probably everything that everyone's just said times 100. That's really helpful, isn't it? Sorry.
Well, and with that to-do list, we can end the session. Thank you all very much for a really fascinating discussion.